Miami has officially claimed the #1 spot in the UBS Global Real Estate Bubble Index for 2025, with a record-breaking score of 1.73, surpassing Tokyo and every other major city on the planet. This isn't just expensive anymore. This is a full-blown bubble at maximum risk of implosion. Home prices are now nearly 6 times the local median income. Insurance costs have exploded beyond affordability. And the market correction that experts warned about? It's no longer coming. It's already here, unfolding in real time across South Florida. According to UBS Global Wealth Management analysis, Miami's housing mispricing has reached levels that signal extreme vulnerability, surpassing even notorious bubble markets like Zurich and Los Angeles. Behind the palm trees, the ocean views, and the Instagram-perfect skyline, a financial storm is brewing that could devastate homeowners, crush investors, and reshape the entire South Florida real estate landscape. Is your dream home about to become your worst financial nightmare? Stick around, because in this breakdown, we're exposing exactly why Miami topped the global bubble risk rankings, what it means for buyers and investors, and the brutal market forces that are triggering one of the most dramatic housing corrections in modern American history. Hit subscribe to Housing Intel and ring that bell so you never miss data-driven real estate intelligence like this. The bubble score that shocked the world. Miami didn't just rank high on the UBS Global Real Estate Bubble Index. It shattered records. With a bubble risk score of 1.73 in 2025, Miami reached the highest level ever recorded for any city in the index's history, marking the second consecutive year at the top of this ominous ranking. To understand the gravity of this score, you need to understand what it represents. The UBS Global Real Estate Bubble Index analyzes 21 major cities worldwide, measuring residential property price distortions based on factors like price-to-income ratios, price-to-rent ratios, mortgage affordability, and construction activity relative to economic output. Any score above 1.5 indicates high bubble risk, meaning prices have detached dangerously from fundamental economic realities. Miami's 1.73 doesn't just exceed that threshold, it obliterates it. Tokyo came in second with a score of 1.59, followed by Zurich at 1.55. Los Angeles, Geneva, Amsterdam, and Dubai also registered elevated risk, but none approached Miami's catastrophic level. What makes this even more alarming is the trajectory. Miami's score increased from the previous year, signaling that the bubble isn't stabilizing or deflating gradually. It's expanding into even more dangerous territory, building pressure that will eventually have to release. Markets don't sustain this level of mispricing indefinitely. History shows that the higher the bubble climbs, the harder and faster the correction hits. And Miami is now perched at the very peak. The brutal disconnect between prices and incomes. The foundation of Miami's bubble risk lies in a simple but devastating math problem. Homes cost far more than local residents can afford. Miami's median single-family home price sits around $595,000 to $600,000 as of late 2025. Meanwhile, according to U.S. Census Bureau data, the median household income in the Miami metropolitan area is approximately $76,000. That creates a price-to-income ratio of nearly 6 to 1, meaning the typical home costs almost 6 times what the typical household earns annually. Financial experts generally consider a ratio of 3 to 4 times income as sustainable and healthy. Anything above 5 times signals severe affordability stress and market instability. At 6 times, Miami has entered crisis territory. To put this in perspective, a household earning $76,000 can typically qualify for a mortgage financing a home around $300,000, assuming traditional lending standards, a reasonable down payment, and mortgage rates in the 7% range. That's half the median home price in Miami. The gap is staggering and unsustainable. This disconnect didn't happen overnight. Since summer 2019, median single-family home prices have surged over 70% across Miami-Dade, Broward, and Palm Beach counties, substantially exceeding the 50% national median increase during the same period. Pandemic-era remote work migration, international buyer demand, and historically low interest rates between 2020 and 2021 fueled explosive price growth that local incomes simply couldn't match. Now that those temporary demand drivers have faded, the brutal reality is setting in. Local workers, young families, and even middle-class professionals are being priced out entirely, forced to rent indefinitely or leave the region. The only buyers who can afford Miami's inflated prices are high-income out-of-state migrants, foreign investors, or those with substantial existing wealth. But those buyer pools are limited and increasingly cautious. When local demand collapses and external demand slows, inventory piles up, prices fall, and the correction accelerates. Miami is living that nightmare right now. The insurance crisis crushing homeowners. If unaffordable home prices weren't devastating enough, Miami homeowners face another financial catastrophe: exploding insurance costs. Florida's property insurance market has become one of the most expensive and unstable in the nation, and Miami sits at the epicenter of the crisis. Since 2022, average homeowners' insurance premiums in Florida have surged over 60%, according to Bloomberg analysis. In Miami specifically, homeowners in flood-prone areas or hurricane-vulnerable zones now pay between $8,000 and $12,000 annually for property and flood insurance combined. That's $660 to $1,000 per month just for insurance, before factoring in mortgage payments, property taxes, HOA fees, or maintenance costs. For a household earning $76,000 annually, that insurance bill alone consumes 11 to 16% of gross income. Add a mortgage payment of $3,000 to $4,000 monthly on a $600,000 home at 7% interest, and you're looking at total housing costs exceeding 60 to 70% of income. That's not sustainable. That's financial suffocation. The insurance crisis stems from multiple converging factors. Climate change has intensified hurricane frequency and severity, driving massive claim payouts that have bankrupted several Florida insurers in recent years. Major national carriers like State Farm and Farmers have pulled out of Florida entirely or severely limited new policy issuance, shrinking the market and driving prices skyward for remaining providers. Reinsurance costs, the insurance that insurance companies buy to protect themselves, have skyrocketed globally, and those costs get passed directly to Florida homeowners. Miami's coastal geography makes it especially vulnerable. Properties near the ocean face escalating flood risk from sea level rise and storm surge. Even inland areas see elevated premiums due to region-wide risk assessment. Some homeowners can't find coverage at any price, forcing them into Florida's state-backed Citizens Property Insurance, the insurer of last resort, which charges even higher premiums and offers limited coverage. For buyers, this creates an impossible equation. Even if you can afford the mortgage, can you afford the insurance? Can you stomach the risk of losing coverage entirely if your insurer goes bankrupt or exits the state? These questions are causing buyers to vanish from the market, inventory to accumulate, and sellers to slash prices, desperately trying to move properties before conditions worsen further. Inventory surge and price collapse. In progress. Miami's housing market isn't just cooling. It's collapsing under the weight of surging inventory and evaporating demand. According to Miami Association of Realtors data, single-family home prices fell 4.8% year-over-year in late 2025, while condo prices plummeted 8.5% during the same period. Total home sales dropped 8.7% compared to the prior year, signaling a dramatic pullback in buyer activity. Inventory levels tell an even more alarming story. Active listings have surged across Miami-Dade, Broward, and Palm Beach counties as sellers rush to exit before prices fall further. Properties that once sold within days or weeks now sit on the market for 60, 90, or even 120 days. Price reductions have become the norm, with over half of listings featuring cuts ranging from $20,000 to $100,000 or more. Condos are particularly vulnerable. Miami's condo market exploded during the pandemic boom, with luxury high-rises sprouting across downtown Miami, Brickell, and beachfront areas. Developers flooded the market with new supply just as demand began cratering. Now, those shiny new units sit empty. Developers offer desperate incentives, and existing condo owners face catastrophic equity losses. The combination of falling prices, rising inventory, and collapsing sales volume creates a vicious downward spiral. As prices drop, buyers delay purchases expecting further declines. As inventory grows, sellers panic and cut prices more aggressively. As sales volume falls, the local economy weakens, unemployment rises, and affordability deteriorates further, perpetuating the cycle. Miami is trapped in this death spiral right now, and there's no clear bottom in sight. Mortgage rates and cost of living, amplifying the pain. Miami's affordability crisis isn't just about home prices and insurance. It's about the total cost of living in one of America's most expensive metro areas. Mortgage rates remain stubbornly elevated, hovering above 7% throughout most of 2025, despite earlier expectations of Federal Reserve rate cuts. At 7%, the monthly payment on a $600,000 mortgage with 20% down is approximately $3,200, not including insurance, taxes, or HOA fees. Add those costs, and total monthly housing expenses easily exceed $5,000. For a household earning $76,000, that's nearly 80% of gross monthly income, far exceeding the 28% threshold that lenders traditionally consider sustainable. Miami's overall cost of living sits 23% above the national average, driven by expensive housing, high food costs, elevated transportation expenses, and premium prices for basic services. Rent isn't cheap either. The median rent for a two-bedroom apartment in Miami exceeds $2,800 monthly, pricing out even those who choose renting over buying. Younger workers, service industry employees, teachers, and public sector workers are being forced out of the city entirely, creating labor shortages and economic stress. The unemployment rate in Miami's metropolitan area stood at 3.7% in mid-2025, relatively low compared to national averages. But employment strength hasn't translated into wage growth sufficient to keep pace with housing costs. Real wages, adjusted for inflation and housing expenses, have declined for most Miami workers over the past 3 years. This creates a paradox. Miami's economy remains relatively strong, yet local workers can't afford to live there. The city is becoming a playground exclusively for the wealthy, while the middle class and working families get priced out systematically. That's not sustainable economically or socially, and it's a major factor driving the current market correction. The collapse of pandemic-era demand. Miami's explosive price growth between 2020 and 2023 was fueled largely by temporary pandemic-era dynamics that have now reversed completely. Remote work migration brought thousands of high-income workers from expensive cities like New York, San Francisco, and Los Angeles to Miami, seeking lower taxes, better weather, and more space. Tech workers, finance professionals, and corporate executives flooded South Florida, bidding up prices aggressively and creating a seller's market frenzy. But that wave has crested and crashed. Many remote workers have been called back to offices as companies end flexible work policies. Others discovered that Miami's high cost of living, insurance chaos, and climate risks outweighed the benefits of sunshine and no state income tax. Return migration is accelerating, with former pandemic migrants heading back to traditional hubs or relocating to more affordable Sunbelt markets like Nashville, Austin, or Raleigh. International buyer demand, another pillar of Miami's market, has also cooled. Wealthy buyers from Latin America, Europe, and Canada historically flocked to Miami for investment properties, vacation homes, and safe haven assets. But global economic uncertainty, strengthening currencies in some home countries, and Miami's elevated prices have reduced international transaction volume. Investors who bought at the peak are now facing negative equity or minimal returns, prompting many to sell and cut losses. Institutional investors and short-term rental operators who scooped up properties during the boom are now offloading inventory as rental yields compress and regulatory crackdowns on Airbnb-style rentals intensify. Miami-Dade County has implemented stricter regulations on short-term rentals, reducing profitability for investors who relied on vacation rental income to cover mortgages and expenses. Younger buyers, the traditional engine of housing demand growth, are almost entirely absent from Miami's market. Millennials and Gen Z workers face student debt, stagnant wages, and home prices that are completely out of reach. Homeownership rates among younger demographics in Miami have plummeted, creating a missing generation of buyers that leaves the market overly dependent on older, wealthier purchasers. As all these demand sources dry up simultaneously, Miami faces a supply-demand imbalance that can only resolve through significant price corrections. The market is rebalancing brutally and rapidly. Comparing Miami to global bubble markets. Miami's position atop the UBS Global Real Estate Bubble Index places it in notorious company. Tokyo ranked second with a score of 1.59, driven by decades of monetary stimulus, ultra-low interest rates, and demographic pressures. Zurich came in third at 1.55, reflecting Switzerland's status as a global wealth haven with limited housing supply. Los Angeles scored in the elevated risk category, facing similar affordability crises driven by constrained supply, high demand, and regulatory barriers to construction. Geneva, Amsterdam, and Dubai also registered high bubble risk, each with unique dynamics but shared characteristics: prices far exceeding local incomes, speculative investment activity, and vulnerability to demand shocks. What distinguishes Miami from these other bubble markets is the speed and intensity of its price appreciation and the severity of its correction. While Tokyo and Zurich have maintained elevated valuations for years through strong economic fundamentals and supply constraints, Miami's bubble inflated rapidly during a brief pandemic boom and is now deflating just as quickly. Miami lacks the deep economic diversification of global financial centers like Zurich or London. Its economy relies heavily on tourism, real estate, finance, and international trade, sectors vulnerable to economic downturns and geopolitical instability. Miami also faces unique climate risks that cities like Tokyo or Los Angeles don't. Hurricane exposure, flooding, and sea level rise create existential threats that insurance markets are increasingly pricing in. As climate risks intensify, Miami's long-term viability as a premium real estate market comes into question. European cities with moderate or low bubble risk, like Paris, London, and Milan, benefit from centuries of established demand limited developable land, and strong regulatory frameworks that prevent speculative excess. Miami has none of those protective factors. It's a relatively young, sprawling metro area with abundant developable land inland, making supply expansion easier and price corrections more severe when demand collapses. São Paulo registered the lowest bubble risk among all analyzed cities, reflecting Brazil's economic challenges, currency volatility, and affordable housing relative to local incomes. Miami sits at the opposite extreme: maximum risk, maximum overvaluation, and maximum vulnerability to correction. What this means for buyers and investors. For prospective homebuyers, Miami's bubble status sends a clear message: wait. Buying at the peak of a bubble guarantees financial pain. Prices are falling now and likely have much further to drop before reaching sustainable levels supported by local incomes and economic fundamentals. Buyers who purchase today risk negative equity within months, being underwater on mortgages, and losing substantial down payments. Patience is the best strategy. Let the market correct, let inventory accumulate, and let sellers become desperate. Opportunities will emerge at 20, 30, or even 40% below current asking prices as the correction deepens. For current homeowners, especially those who bought recently at inflated prices, the situation is grim. Selling now likely means taking a loss, but holding on means potentially watching equity evaporate further as prices continue falling. Homeowners trapped in high insurance cost properties or facing job relocations face especially difficult decisions. Some may be forced into short sales or foreclosures if they can't afford payments or can't sell for enough to cover their mortgage balances. For real estate investors, Miami presents both danger and opportunity. Those holding properties bought during the boom should evaluate exit strategies before losses deepen. But for cash-rich investors with long-time horizons, the coming correction will eventually create buying opportunities. The key is timing. Trying to catch a falling knife is dangerous. Wait for clear signs of market stabilization, inventory declining, sales volume increasing, price cuts slowing. That's when the bottom is near. For now, Miami remains a market to avoid for new investments. For developers, the message is equally stark: stop building. Oversupply is already crushing prices. Adding more inventory only accelerates the downward spiral. Projects in planning stages should be shelved. Projects under construction should be completed and sold quickly, even at steep discounts, to avoid carrying costs that will exceed eventual sale prices. For the broader housing market, Miami serves as a warning. Bubble dynamics can develop quickly when temporary demand surges meet constrained supply and speculative fervor. But corrections are inevitable and often brutal. Markets that disconnected from fundamental affordability will always revert to the mean, and the pain of that reversion falls hardest on those who bought at the peak or over-leveraged during the boom. The road ahead for Miami real estate. Miami's housing market faces a prolonged correction with no quick recovery in sight. Several factors suggest continued price declines through 2026 and potentially beyond. First, affordability will not improve until prices fall substantially or incomes rise dramatically. Given wage stagnation, income growth is unlikely to close the gap quickly. That leaves price declines as the primary adjustment mechanism. Second, insurance costs show no signs of stabilizing. Climate risks are worsening, not improving. Reinsurance markets remain stressed. Expect insurance premiums to continue rising, further eroding affordability and buyer demand. Third, mortgage rates are unlikely to drop quickly or significantly. Even if the Federal Reserve cuts rates modestly, mortgage rates will remain elevated by historical standards, keeping monthly payments high and limiting buyer purchasing power. Fourth, Inventory will continue growing as more sellers panic and list properties. The wave of pandemic-era buyers who overpaid now face reality and need to sell. Investors exiting the market will add supply. New construction completions will add even more inventory. Oversupply depresses prices. Fifth, economic risks loom. Recession fears, potential job losses in interest rate-sensitive sectors, and global economic uncertainty could trigger broader demand collapse. If unemployment rises in Miami, affordability deteriorates further, accelerating foreclosures and distressed sales. The combination of these factors creates a perfect storm for continued price declines. Some analysts predict Miami home prices could fall 20 to 35% from peak levels before finding a sustainable floor. Condos face even steeper declines, potentially 40 to 50% in oversupplied downtown and Brickell submarkets. Recovery will eventually come, but it will take years, not months. Miami's long-term appeal remains intact. Favorable tax environment, international gateway status, strong population growth trends, and desirable climate, hurricanes notwithstanding. But short-term pain is inevitable as the market purges excess speculation and reprices to sustainable levels. Those who survive the correction and buy strategically near the bottom will reap rewards when the next cycle begins. But timing is everything. Jumping in too early means catching a falling knife. Waiting too long means missing the bottom. Data-driven analysis is essential. The final verdict on Miami's bubble. Miami's ascent to the top of the global housing bubble rankings isn't a badge of honor. It's a warning siren screaming at maximum volume. A bubble risk score of 1.73 doesn't lie. It reflects cold, hard economic reality. Prices have detached from incomes, affordability has collapsed, and a painful correction is underway. The city that symbolized pandemic-era real estate frenzy is now the poster child for bubble risk and market correction. Homeowners are drowning in insurance costs, inventory is piling up relentlessly, and buyers have vanished into thin air. The math doesn't work anymore. A 6-to-1 price-to-income ratio is unsustainable. 7% mortgage rates combined with $10,000 annual insurance premiums make homeownership financially impossible for the vast majority of Miami residents. The dream is still sold, the skyline still glitters, and the beaches still beckon. But behind that glamorous facade, a financial disaster is unfolding for those who bought at the peak or who refuse to acknowledge the brutal new reality. Knowledge is protection in volatile markets. Understanding the data, recognizing bubble dynamics, and having the discipline to wait for sustainable valuations separates smart investors from victims. Miami's bubble will eventually deflate, prices will reset to affordable levels, and opportunity will emerge. But not yet. Not while the correction is accelerating and the bottom remains out of sight. If this breakdown gave you crucial market intelligence you won't find anywhere else, smash that like button right now. Subscribe to Housing Intel for weekly data-driven real estate analysis that cuts through the hype and delivers truth. And drop a comment below. Are you buying, selling, or waiting out Miami's bubble? Tell us your strategy. We read every single comment. Because in real estate, knowing where not to invest can be even more valuable than knowing where to buy. We'll see you in the next video.